There were some changes in the recent Trump tax bill that I don't think are getting covered enough. I actually haven't heard anyone discuss in detail what I'm going to cover in this video. You hear a lot of talk about things like no tax on tips or a higher child tax credit, but most of that stuff is really not going to be relevant to you or anyone who's looking to build wealth. Those are things that are just either not going to be applicable to you or they're only going to save you a couple hundred or a couple $1,000 a year in taxes. And that's not going to move the needle much for someone who wants to get serious about building wealth and achieving financial freedom. But there was one really big change that perhaps might solidify the trend away from full time employment and the outsourcing of all the management of your personal investments. I've long talked about how much I would love to see the era of W 2 employment and the use of financial advisors end, and perhaps this change will be the final push to make that a reality. The key change that I'm referring to is in the one big beautiful bill that permanently repealed the deduction for miscellaneous itemized expenses. Under prior law, before Trump's first tax bill, which we call the TCJA, that he enacted during his first term in office, taxpayers were allowed to deduct these expenses to the extent that they exceeded 2% of their adjusted gross income. Many high income professionals with significant job related expenses or people with high investment management fees that they had to pay every year, this was a pretty valuable deduction. Under Trump's first tax bill, the TCJA, these deductions were suspended temporarily through the end of the 2025 tax year. But the one big beautiful bill did away with them permanently. So let's talk about why this really matters. There's two big ways the elimination of these itemized deductions is likely to have a big impact. First is that it got rid of unreimbursed employee business expenses. These employment related expenses that aren't reimbursed by your company were set to be reinstated for W 2 employees starting in 2026. But that was until this bill did away with those deductions permanently. These include expenses for things like home office costs. So if you have an office in your home that you use frequently to do work from, that could have otherwise had been a deduction even if you were a full-time employee. It also includes things like travel costs. If your business isn't paying for those travel costs or not reimbursing you for those costs, you could have deducted those as unreimbursed employment related expenses. It includes things like professional dues or licensing fees, union dues. It included things like tax prep fees or legal fees in some cases. It also included things like work supplies and equipment and education and training expenses. So this could be things like research materials, classes, seminars, courses, things that you take to try to make yourself a better employee in the future. These are really any cost associated with working or your job that are not otherwise paid directly or reimbursed to you by your company. So for wealthy taxpayers who work full time at a company, these expenses are really going to add up over time, and this could have a significant impact on your tax return at the end of the day. This is not going to be an issue for people who are self-employed or business owners. You're going to continue to get to take these deductions, and you're not going to have any limitations that are going to apply to people who are W 2 employees. The other big change that's relevant here is that you still can no longer deduct investment management fees. So the bill permanently eliminated deductions for investment, advisory fees, or investment management fees. This includes fees that are paid to a financial advisor to manage your stock portfolio, for example, but it also includes fees paid to an investment manager if you're investing through a fund, like a real estate fund or a private equity fund. These advisory fees and investment management fees can really be quite large, and typically the more money you have, the higher these fees are going to be for you in the future. So this is a big loss in our ability to deduct these fees on our tax return. So there's a lot of reasons why financial advisors don't make sense. I talk a lot about that, but hopefully this change in the recent Trump tax bill will be the final nail in the coffin for anyone who's still using a financial advisor to manage all of their investments. But you may be asking yourself, what about investment funds? Investment funds typically carry pretty high management fees or investment fees that you have to pay that might not be deductible anymore after this change. So you might be asking yourself, why do I still invest in investment funds if I lose the benefit of claiming these deductions in the future? Well, there's a couple of reasons for that. First, the returns should be much higher when you're investing in investment funds or syndications, and that should justify paying the higher fees. So, when you look at the net return, which you should always do after taking into account the fees that you do have to pay, you should still be looking at returns that are much higher than anything that you would ever get in the stock market. The second reason is that there are strategies to get around this or reduce the impact that you might have to not being able to claim these tax deductions. There's things like the management fee waiver strategy that you can do, or other strategies that fund managers use in order to reduce or completely eliminate this issue of not being able to deduct these fees going forward. The last thing with investment management fees, when it comes to fees you're paying when you're investing through an investment fund, you can call these fees whatever you want to. But in my opinion, and the way I think about this, I'm really paying a fee for access to the deal. I'm getting the opportunity to invest in something through an investment fund that I would never otherwise be able to invest in myself. And I also, to some extent, view these fees as management of the deal or the administration of the fund itself. So I view these fees, even if they aren't fully tax deductible, that you pay to a fund manager to invest in an investment fund very differently than I view fees paid to a financial advisor. With financial advisors, there's no access issue. You're not getting access to something you couldn't otherwise get. Anyone can invest in the stock market. It's very easy to do. You're also paying them to underperform the market in the vast majority of cases. You could easily make higher returns by just investing in something like an S&P 500 index fund. And also, there's no real workarounds in the context of a financial advisory fee like there are with investment fund managers. So any fee you pay to a financial advisor is just going to be a net cost that you can't deduct on your tax return. So let's shift a bit here to talk about the big themes. So it's easy to understand what tax law changes happened, but we should always focus on what the big picture is. What's really changing? Where's the puck going? We live in a time where critical thinking skills are at an all-time low. So if you can learn to ask these types of questions and capitalize on them, then you're going to be so far ahead of the pack. So let's think about who these changes really help. The first group of people that they really help are business owners and people who are self-employed. This has been a long time coming. I really don't think that younger generations want to be full-time employees or spend their whole lives trying to climb the corporate ladder. It's been obvious to me for a long time that the best and brightest just don't want to go the corporate route anymore. That's not to say everyone has to be Jeff Bezos working around the clock to build the next Amazon. But some of the brightest minds right now are working for themselves, turning away clients left and right because they are so good at what they do and they have more than enough work coming in, but they don't want to spend every waking hour of their day working. I'm not trying to say that no one should ever be a full-time employee or go work for a company anymore. If that's what you really want to do, then by all means, you should go for it. But you can't complain anymore about how much tax you're paying. If you are going to be a job taker instead of a job creator, you are going to be taxed very heavily for it. And you're going to have to work twice as much to get to the same spot than you needed to. The other group of people who are really helped by this change in the One Big Beautiful Bill are people who manage their own investments. So yes, I'm a big advocate of investing in things through investment funds or syndications in some cases. But it's really important to recognize that the best way to invest is by fully executing and managing the investment yourself. The best investment that you can ever make is always going to be in yourself or in something that you are going to manage personally. At this point in my life, I don't have the time or the desire to go out there and analyze every AI or blockchain startup company. I don't have the time to try to meet with hundreds of CEOs of startups. I don't have time to go through all the data on their companies. So I'm happy to invest passively in this space through a venture capital fund. But I fully recognize that if I did go out and do all this work myself, my returns would be significantly higher. I also have absolutely zero desire to go out and try to buy and manage apartment buildings myself. So I invest passively in these types of properties through real estate funds and syndications. But I really want you to understand that if I did want to go out and do these things myself, assuming that I did them right, I stayed on top of all the developments in the industry, and I really knew what I was doing and put in the work for it, that my returns would be significantly higher. My fees would be a lot lower, and my tax result would be much better. So, the key point to understand here is that whenever you make an investment passively, whether that's through an investment fund or in a public company through the stock market, or any situation where you're not actively managing that investment, it could be a lot better if you did it yourself. But that's not reality. If we want to build wealth, we're going to have to find ways to invest our money passively. There's only so much time in the day that we can spend on this stuff, so it's really not practical to think that you're just going to actively manage every single thing that you do with your money. I also think it's very prudent to not put all your eggs in one basket and to diversify your investments. But while you are, of course, going to need to make some passive investments, you need to understand that the best path to building wealth is to always do the thing yourself. And when you do make passive investments, you better make sure that it's a good one and that you're not just paying someone to do something that you could easily do yourself. I want to end with talking about who this change with the permanent elimination of itemized deductions is going to hurt the most. So, if it's not obvious by now, the people most hurt by this change are W 2 employees and people who outsource the management of their investments. A big problem here is that a lot of times people who are full-time employees are the type to outsource the management of all their investments. So look, I get it. I've had jobs where you work all the time before you get home from the office every night at 9 or 10 after a miserable day at work, and all you want to do is just start drinking and watch TV. And the last thing you want to do in your free time is to watch finance videos on YouTube. But kudos to any of you who are full-time employees and are still watching these videos. That is super impressive and shows a lot about the level of discipline that you do have. But it's kind of a cycle, honestly, where you work all the time at the office and then you just have to outsource everything else, from cleaning to cutting your grass to managing your personal investments. I frequently hear people say things like, not everyone can be self-employed or a business owner. I generally do agree with that. I think not everyone has what it takes to be self-employed or a business owner. Just like not everyone has the discipline or the confidence to manage their own investments. And it's certainly true that not everyone has what it takes to be wealthy. Fortune favors the bold. So make sure that you're paying attention to these trends. If you do want to get serious about building wealth and achieving financial freedom, it's critical that you start thinking about making that switch from full-time employee to self-employed or business owner. And for God's sakes, please stop using a financial advisor if you haven't already. Make sure you subscribe to the channel so you can stay updated on all the best tax and investment strategies that you need to know about.